You've been told you need 20% down, perfect credit, and a fat bank account to buy investment property. What if I told you there's a door most people walk right past one, where the seller becomes your bank, and suddenly zero cash deals aren't just possible, they're happening every day. Imagine you're standing in front of a rental property that could generate $2,000 a month in cash flow. The seller wants out, but here's the thing, they don't necessarily want all their money right now. Maybe they're retired and actually prefer steady monthly payments over a lump sum that'll just sit in a low interest savings account. So what happens when you propose something radical? You ask them to finance the deal themselves. No bank, no mortgage company, just you and the seller drawing up terms that work for both parties. Here's where it gets interesting. While everyone else is getting rejected by traditional lenders or draining their savings for down payments, you're negotiating directly with someone who has one massive advantage over Wells Fargo. They actually want to sell this specific property. They're motivated in ways a faceless corporation never will be. The mechanics are surprisingly simple, almost suspiciously so. The seller holds the note, you make monthly payments, and you get the deed, or at least equitable interest, right away. You're building equity while they're earning interest, and nobody had to beg a loan officer for approval. But let's be honest about what's really happening here. You're essentially convincing someone to become your private lender, and that requires something banks don't care about, an actual human connection. You need to present yourself as reliable, your plan as solid, and the deal as beneficial to them. Think about the seller's position for a second. They're probably older, they've owned this property for decades, and the thought of a massive tax hit from selling outright makes them queasy. Seller financing lets them spread that capital gain over years, potentially keeping them in a lower tax bracket. Now picture the alternative universe, where you tried the conventional route. You need verification of employment, 2 years of tax returns, a debt-to-income ratio that satisfies some algorithm, and probably a small sacrifice to the credit score gods. Seller financing bypasses that entire circus. Of course, this isn't a free money glitch. The seller might charge a higher interest rate than current market rates because they're taking on risk without the infrastructure banks have. They're betting on you, and that bet comes with a premium. Here's the part nobody puts in the motivational Instagram posts. Not every seller will go for this. Many want their cash now, or they're already locked into a plan that requires a traditional sale. You'll hear no more often than yes, and that's just the filtering process at work. But when you find that right seller, the one who values security over a lump sum, magic happens. You're suddenly controlling an asset with potentially zero money down, depending on how creative the terms get. Maybe you're taking over their existing mortgage payments, maybe they're carrying the entire note, maybe it's some hybrid structure your accountant will have fun with at tax time. The ripple effects hit fast. While your friends are still saving for down payments, you're collecting rent checks and building a portfolio. The velocity of your investing accelerates because you're not waiting years between deals to rebuild capital. Some critics will tell you this is risky, that you're over-leveraged, that you're one bad tenant away from disaster. And look, they're not entirely wrong. Leverage cuts both ways. But calculated risk isn't the same as recklessness. And every investment strategy has a downside if you ignore due diligence. The real innovation here isn't just the zero cash aspect, it's the relationship-based approach to acquiring assets. You're solving the seller's problem while solving your own, creating a win-win that traditional financing often can't accommodate. That's not a loophole, that's just better alignment of interests. As the real estate market shifts and morphs, seller financing adapts with it. When banks tighten lending standards, these deals become more attractive. When interest rates spike, sellers who bought decades ago at 4% suddenly look like generous lenders at 7%. Despite all the noise about real estate crashes and market corrections, the fundamental appeal of seller financing persists. It's flexible, it's personal, and it doesn't require permission from corporate underwriters. The same creative structure that worked in 1985 works today, just with different numbers. Here's the kicker though. Most people won't do this because it requires actual conversation, negotiation, and the mild discomfort of proposing something unconventional. They'd rather fill out loan applications than have a real discussion with a motivated seller. That reluctance is your competitive advantage. So is seller financing the secret to buying with zero cash? It's not the only secret, but it's definitely one of the most overlooked tools in the arsenal. It requires hustle, creativity, and the willingness to structure deals that don't fit in standard boxes. The game is still being played right now in small markets and big cities by investors who understood that the person selling the property might just be the best lender you'll ever find. But the next evolution is already forming. Creative financing is getting more creative, and the strategies are getting sharper. That's the reality behind the late night infomercials and guru promises. Real estate investing isn't about having the most money. It's about finding the most motivated partners and structuring deals that serve everyone involved. And if you're serious about finding those opportunities, head over to www.growthsense.com, where we've built a directory specifically for investors hunting their next property. The deals are out there, you just need to know where to look.